I wanted to talk to you about 10 things I've learned in my first year as a public company CFO. It's a big step up from being a divisional CFO. It's a really interesting and fun job, and I think it's an interesting day to reflect on this on the day of the Enron verdicts. So it's a very important thing to kind of think a little bit about what you're doing and the message you're carrying out to the financial community and your shareholders. So I'm going to try to make this interesting and fun, so see how we do. I want to talk about these things that I've learned were to be prepared, know who your bosses are and what they want, set a few goals, but not too many goals, know what your organization is about, the good parts and then the warts as well, and play to your strengths. The things that I came to the job knowing were the balance sheet and corporate development. I've been an assistant treasurer and head of corporate development, as Bob said, at PepsiCo, where we were pretty well trained. I put together a pretty good team. But what you have to do in this job, because you have a constant stream of demands coming at you, is learn to say no. You have to prioritize and focus and learn to say no. That's been important. As you may have noticed, there are not a million women CFOs these days, and I've found that the ladies' room can actually be a goldmine for intelligence, and I'm going to talk a little bit about that. And then there are just some days that are bad days. We've had a bit of a stock price adjustment, and not in the right way at Moodys lately, so I'm going to talk about that. And then on this day of the Enron verdict, I'm going to talk a little bit about how the tone at the top really drives the culture of places, because it's very important to know. Now, on the be prepared front, as Bob was kind enough to say, I am a graduate of Lehigh, the 18th best undergraduate business school in the U.S. So Business Week has just granted it as such. And in fact, a woman named Alice Gast, who was a chemical engineering professor here, has just been named president of Lehigh. She's most recently provost at MIT. So another in a list of women becoming university presidents. Pretty interesting. So after I made a bit of a detour there to the Army, I enrolled here in 1984 and was a member of the quite successful class of 86. So it is 20 years for me at this point. So professional experience is even more helpful. And as Bob said, I did this thing, which had absolutely no bearing on anything that I've done since. But I did have the choice of going to West Point for the first class of women through West Point, or to Lehigh, where my father went. And having decided that it was countercultural enough to go through ROTC and become an Army officer, I chose to do that. And actually, it was pretty good leadership training. So, but a bit of a different, untraditional kind of background. Now, many of the companies that I work for in investment banking, I'm sad to say, no longer exist. This is a bit, I guess, humbling. I looked for the logo for First Boston. The First Boston Corporation had a big ship. It became part of Credit Suisse, which then decided last year to drop the old First Boston name. So I did oil and gas M&A there under Bruce Wasserstein and Joe Perella, but First Boston, as we know it, is lost to the history books. Similarly, Bankers Trust, a company which was bought by Deutsche Bank, did oil and gas M&A there. I was explaining to some of the professors today that some of the folks from Bankers Trust made their way to Enron. And a very interesting story there. Bankers Trust was really in the forefront of doing derivatives and not always in the most constructive way. But from Bankers Trust, I got recruited to PepsiCo, and corporate experience is really very useful. Pepsi's a great company and was a terrific learning experience and is obviously doing quite well. So then from there, I went to a small consulting firm, and then I went to U.S. Trust, working for Schwab, as Bob said, and then I got this job. So the point of this is there's not a linear path to where you're going to be in 20 years, and if you think you can plan out your life as to where you're going to get to 20 years from now, it's probably not going to work exactly as you have it planned out. So leave yourselves open to different experiences and you'll do fine. Now, balance. The new model for women professionals is you're supposed to have a stay-at-home husband. This is the new thing. You're supposed to have a husband who kind of takes care of everything on the home front so you can have a big job. And I've failed at that miserably, because that guy on the upper left there is my husband, Victor Lopez Balboa. Somebody here in this group actually used to work for my husband at Goldman Sachs. He runs the FIG group, and he has 270 employees in a billion-dollar business. So I've failed on the stay-at-home spouse front. The other thing you're supposed to do is have grown children. Now, as you can see from the picture here, my children are hardly grown. They're now 14, 10, 7, and 4. So it's a little hard to juggle all this, but it can be done. And I'm sure it is much easier if you have grown children, but we're not there yet. So in addition to being prepared, another good thing to be able to do is to know your bosses and know what they want. Now, in the scheme of things in our public company, that's me, way down there. And very important, $20 billion company, we have a very important place in the capital markets, so it's a big job, right? And I'm very important. Well, actually not. That's my boss, Ray McDaniel, who is chairman and CEO of Moodys Corporation. Great guy, former lawyer, terrific boss, and I feel very fortunate to work for a guy like Ray, who's a high-integrity guy. But on our board, we have these 7 exalted people. We have Basil Anderson, who was the CFO of Campbell's and vice chairman of Staples, a former CFO, number 1. Bob Glauber, who runs the NASD. Ewald Kist, who used to run ING. Senator Connie Mack. Hank McKinnell, who has a PhD from this institution and is now CEO of Pfizer, also was a CFO. Nancy Newcomb, who ran risk at Citi and also was a CFO. And John Wolfe, who, just to make it really, really difficult, used to serve on the FASB. So I had to interview with him and answer accounting questions, which was actually quite interesting. So, what do you think of FAS 133? Well, you can't really answer that honestly because it's a pretty difficult thing to deal with, but that's our board, 4 former CFOs. On most boards, no one wants to be the financial expert. On this board, everyone except Connie Mack is a certified financial expert. So you have your board, 1 insider, my boss, 7 outsiders, 7 extraordinarily well-qualified outsiders. So those are the guys we work for. Now, this is a famous guy, some of you may know. Goldman Sachs Asset Management owns 7% of our firm. So I kind of work for Hank, which is helpful because my husband also works for Hank, so we're pretty tuned into what Hank wants. Ken Feinberg, Davis Select Investors, they also own 7% of our company, so he's my boss too. And then last but not least, we work for God. Warren Buffett owns 16.5% of Moodys. We are his 3rd largest holding. Warren gives us very specific, exacting advice. His advice this spring when we wanted to go see him was, just don't do anything dumb. So we work very hard to follow Warren's extremely exacting advice. And so Warren is terrific. He doesn't bother us too much, and we continue to try not to do anything dumb. These guys at the top are people that we have to talk to all the time. If you're a CFO, you pay attention to your shareholders. If you don't, your career is going to be more limited. We're lucky to have a very strong group of shareholders with a lot of consistency. 50% of our holders are 10 very strong institutions, so that's good. And we have a very strong board advising us. So you can see my relative importance in this entire group of bosses that I have. So in terms of setting goals, and not too many, when I came in, Moodys is a small company that's become a very big company, and it's become very successful. So we wanted to get the team aligned around what we should do. Really 4 things we're trying to do: drive growth and profitability, support the line business, put in place a good control environment. Pretty important if we're Moodys because we rate everybody else, and if we screw it up, it's kind of a major problem. And then make it a great place to work. We've added the human resources team to the finance team, and so we've been able to do that. So we know what our goals are, and we try to keep them simple so my staff of 200 can follow what we're trying to do. So the next thing I had to do was learn the organization. Moodys is a rating agency. Some people think that's actually very boring. Well, it's not boring because you sit at a very important place in the capital markets. And as someone pointed out, we rate 100 nations, and we rate 11,000 companies. 25,000 public issuers, 70,000 structured finance obligations, and we do credit risk, quantitative analytics, as you see at the bottom. So the opportunities to annoy clients are just extraordinary in number and scope. So you have to be very careful about dealing with your clients. We spun off from Dun & Bradstreet in 2000, along with Coach. We were probably one of the most successful spin-offs in that year. So our market cap was $4.5 billion at the spin. It's now been up to 20. It's back down to about 17 right now. And we were named one of the 10 best, one of the best managed companies in business services during that time. We have 3,000 employees in 22 countries, so it's a big company. So that's the growth record. I have to make sure that you understand that this is a log scale. Our previous CEO liked to use this, but we've only had a couple of weak years there when the credit cycle has been difficult. But consistent history of great revenue growth, great profit growth. So the company is terrifically strong. It's a cash engine. Our cash flow equals our operating income. We have 54% margins, and the business model is just extraordinary. So we're very lucky to be able to put up numbers like this. Revenue distribution by country, we're 63% U.S., the rest international. The international businesses are growing faster. Structured finance is really the exciting part of what we do. The corporate part of rating companies, about 20% of our revenue. The credit derivatives business, the yellow piece up there, is just about the same size. So the structured business has really become much bigger than the fundamental business for us, and it is a much higher growth rate. So that's what we do. And the real engine of the company is the structured finance business. We have a lot of quants, we have a lot of mathematicians and lawyers and people who look at all different types of things that you can rate in the structured finance area. In 1992, those were some of them. And in 2006, those are some more of them. I was telling Jim this morning that my favorite particular class of securitized things are cosmetic surgery receivables. I'm not sure that's a burgeoning asset class, but it is one that exists. So if you look at this list, which you can't see on purpose, it's a pretty interesting list. But we rate a lot of very strange things. The stock performance of the company with all that has been pretty good. I'll get to the recent past, but about the time here that I was asked to make this presentation, our stock price was right about there. So be careful what you wish for. In terms of challenges, this is a very interesting slide. This slide was in our investor presentation. And if you look at the revenue growth there, pretty spectacular revenue growth. The PP&E there, though, which our previous chairman used to say is commendable because of its extraordinary flatness. It kind of looks like New Jersey. You know, it's just really flat. Perhaps we have to look a little bit about how much we're investing in this business, which is growing so rapidly. So that's one of the things that I have to wrestle with. But you have to realize what's good and what's bad about the company that you're working in, and that's a challenge that we face. So in terms of when I got this job, what did I do? The balance sheet last June, we had a spectacular amount of cash on the balance sheet, almost $1 billion. For those of you who are going to work at hedge funds, and I would expect that's most of you in this audience, hedge funds don't like having a lot of cash on the balance sheet. They think it's an underused asset, and it tends to attract them. So we've been working down our cash balance. Was at $605 million at the end of March. But something that we're working on redeploying that cash. The return on our cash we took up a bit by investing in a little bit longer lived assets and making sure that we just were handling the treasury piece better. We bought back some shares, which hadn't been done too well. And you think Moodys, a company which rates debt, I really wondered why we were sitting with this 7.61 piece of coupon on our debt last year. So I had noted that interest rates had come down a little bit, thought it might be a good idea if we refinanced. So we actually did that pretty successfully last year. That was great. So we did all that stuff, and the stock price went from $44 to $71 in 1 year. So, or actually less than that. This was sort of 3 quarters. So that was pretty good. That was kind of neat how that all worked. Market capitalization went from $13.5 billion to $20 billion. That was pretty good. That was a good first couple of months. So I asked my boss if I could have a corporate development team because we probably ought to look outside the base rating business, and he said fine. We hired a guy from Citibank who's doing that. So we've built up a strategy side and an M&A execution side. We only have about 7 people now doing this. Our rivals at S&P have about 50. And we've been able to do some deals. We bought Economy.com, which is an economic consulting firm, and we bought a business in Israel. We bought in a rating agency in Israel and one in the Czech Republic, and then we've bought into a rating agency in China, which takes a long time to get done. So we're expanding the worldwide scope, which is good. And I hired some people, got some people from the outside. Good to have a strong controller. If you're the CFO and you're not a CPA, I would suggest that you get the strongest, nastiest, meanest, biggest controller you can find. So I did that. He's kind of Dr. No. We appreciate him for that. And former D&T partner, so he's very helpful to me. I have an outside person who does planning, tax, and treasury. We have a very good staff at Moodys. We're able to do that. The investor relations person, formerly of Morgan Stanley, has been there for a few years. The head of internal audit joined us recently. And then we added the human resource department. For reasons that are unclear to me, we have a structured finance lawyer from Australia who runs our human resources group. It works. The structured people respect her, which is terrific. Then we added corporate development and real estate. We had no real estate function when I got there. Offices in now close to 30 countries with no real estate function. So the transition from small to large is really pretty hard to manage, and you've got to get that right. So we had to add some of these folks. So the point here, you want some people from inside, you want some people from outside. You've got to get out of a mindset and add some people who have more up-to-date skills. So prioritization and focus. What does the boss do and what do I do? Ray McDaniel spends a lot of his time talking to outside regulators, talking to Congress, talking to our shareholders, and his focus is maybe 25% internal. My focus is about 25% external, spending time with shareholders. But the job is to free up Ray so he can get out and talk to people. And the time management challenge, which you guys probably don't think about quite as much yet, I get 6 internal meetings a day, at least 1 or 2 meetings with shareholders. I get 200 emails a day from around the world. I get 10-plus vendor cold calls a day. Do not have your name on the website as a CFO because you get calls from everyone all the time. Really difficult. Investment bankers. I could spend my entire day just talking to investment bankers. That would be an interesting use of my time, but not particularly profitable. I should add consultants to that group as well. So I could talk to these people all day, but it's not really a great use of shareholder time. Constant meeting and speaking requests, which I generally turn down, but I decided maybe I should take this one. So the solutions to all that, you have to learn to say no. You have to say we've got to focus on what we have to do right now, and you just have to tell people I can't do it. You need a good assistant. I don't do week events during the week. I have 4 kids. I do geometry and reading and complex fractions when I go home in the evening. So I tend not to do too many outside things, and as I said, I tend to try to stick to our knitting, which is a good use of time. Now, the ladies' room. Being a female CFO is very interesting. You can't fix what you don't know. So it's very important to have open communication lines. And our previous CEO was not really always one to communicate really very well with everybody. So I try very hard to talk to people, to know their names, to be approachable, to be positive, ask for people's input. And people come up to me in the ladies' room and they say the darndest things. You know, it's just amazing what you learn just hanging out in the ladies' room. So I find that to be a very good informal channel for communications. And we do skip-level meetings. We walk around. We go to our international offices. Very, very important when you're dealing with professionals who are very sophisticated, that you actually get out and engage them and talk to them. Otherwise, very hard to have their trust. Now, despite all this great stuff, some days are just very bad days. So recently we had a bad day. April 26th, I got on the earnings call. Earnings call is a very high-pressure event. We announced this: revenue growth of 13% in the first quarter, operating income growth of 12%, EPS growth of 26%, operating margin of 54%, took the tax rate down 150 basis points, and we announced that we had done a deal in China. Now, for most companies, you'd say that's a pretty darn good first quarter. Would love to have things like that happen. That's great. So our consensus estimate, for those of you who know how Wall Street analysts work, 49 cents. We announced 49 cents. Okay, good enough. That's fine. The stock price did that. Now, the problem with this is when you have a stock that has done particularly well, the expectations are very high, and you have some things show up which are not always good things. You have that guy show up. So I was on vacation in March, and we were in Hawaii, and my husband calls me, and he says, look at this. Kramer is talking about Moodys, and he was throwing chairs and making mooing sounds and doing all the stuff that Kramer does. And he was talking about how wonderful Moodys was and how what a great business model it was and this and that, and told everybody they should go out and pile into Moodys stock, which momentum investors continue to do right up about into that peak. So this was not the best of phenomenons for a company that's largely institutionally held. So this is what the analysts said. We're a perennial surpriser. For the first time in 20 quarters, we didn't beat estimates. Inline is not good enough. Momentum investors were exiting. And so 1 cent, although we did hit consensus, 1 cent, $4.5 billion loss in value. So this job is not for the faint of heart. And sometimes I think back on my Army experience, and I realize people don't have live ammunition to shoot at us, so maybe it's not all that bad. But this is a difficult situation to manage through. So we took a look at how we've done over the last 5 years. Still a tremendous stock. Still a lot of growth potential in the company. Absolutely nothing has actually changed. So I can't really tell you how we've dealt with this because we're in between earnings periods. But if you tune in on June 6th to our Investor Day, you'll see what we've actually done about this. So it's been an interesting thing to manage through. Now, the tone at the top and cultural responsibility. I thought this is Stanford. I can actually talk about these things. Probably couldn't make this presentation at Harvard, but It's a good presentation today on days when Skilling and Ken Lay were found to be guilty, which is interesting. A great job, a huge responsibility being CFO. You can't forget who you work for. You can't forget the clients, the issuers, the intermediaries who are the investment banks that we work with. You can't forget the employees because they can all pick up and go work somewhere else, particularly being in Manhattan. Being a jerk is a very 1990s sort of thing. Being a big ego is not going to work these days. You have to be pretty humble because you have days when your stock price tumbles like ours did, and you've got to be able to relate to your investors and your employees and explain to them what's happened and what you're going to do about it. Thank yous still work. Burning bridges is a very bad idea. And as the public face of your corporation, you really have to be conscious of how your image and the image of your company is coming across to shareholders. And despite all that, it is really possible to have fun. So in 2004, that thing was the Moodys annual report cover. If you look at it very closely, it's sort of a map of the world, but it was white, it was generic, it was actually pretty tedious. So I also got the job of redesigning the annual report. So in 2005, we did this thing. We tried to do kind of cheery California colors, sort of this matrix thing, sienna earth tone pictures of Moodys, in the old days rating auto companies and factories, and then moving up to the high-tech world of today. So that was very well received. And Mr. Buffett said, wow, your annual report is really much more colorful this year. So I felt good about that. That was great. Not that any of that matters, but it's all optics. So Moodys, a traditional company, we do stupid things. We dish out ice cream for the employees once a year, but they really, really like it. So we all put on aprons, and we dish ice cream. And it's a very sort of nice family kind of atmosphere, and people really enjoy it very much. So that tall guy in the middle, Ray McDaniel, is my boss. Chris Mahoney, the guy on the right, rates corporates. So if you want to send your complaints, please send them to Chris there on the right. And we have a terrific team. So it's a great job. It's a lot of fun. It's a big responsibility. But I feel thrilled to have the opportunity that I do. So with that, any questions from anybody? Go ahead.
So you talked about the earnings miss, even though it wasn't a miss. How do you balance sort of the temptation of managing earnings as a CFO and the trouble that got a lot of people in with sort of desire to perform for the market? And there are certain times where it's a judgment call. You probably could add some here or not. How do you maintain discipline?
That's an excellent question. There are some things that you could do on the margin, but given our responsibility in the capital markets, we're very, very careful about what we do, and we sort of have to play the hand that we're dealt. Very difficult to predict our business because it spikes up at quarter end. Structured deals tend to come at quarter end. Very hard to predict where our earnings are going to go, which is part of the reason why we have the challenge that we do. Managing earnings is just not something that you can do anymore. When I was at PepsiCo in the 90s, we watched GE would always put up nicely escalating earnings that were handled just perfectly. Coke would also do that, and it was a great frustration at PepsiCo about that. But we have to sort of deal with what we have, and it can be a little lumpier than you would like. But part of what's happened with Reg FD is you can't talk to the analysts about anything that's coming. So you have an ever-increasing disconnect with the analysts, and that's why you see some of the choppiness in the market that you might not have seen before. It is a tough thing to manage through.
Can you talk a bit about the competitive environment?
Sure. Competitive environment. There are five recognized rating agencies. They're called NRSROs, Nationally Recognized Statistical Rating Organizations. There's Moodys, there's S&P, there's Fitch, there's AM Best in Canada, and Dominion Securities in Canada. The SEC decides who is going to have that sort of recognition from the SEC, and they control it. So we have about 40% of the market. S&P has 40% of the market. Fitch has about 15%, and the others have the rest. And the competitive situation is actually more dynamic than you would think. Fitch has really recently made some big investments, and they're now 20% owned by Hearst, which has made a big investment in them as well. So the competitive situation, while it's relatively stable, is one that it is a competitive marketplace. S&P does some things we won't. We do some things that we have greater focus and structure than perhaps they might. And so it's sort of a relatively reasonable competitive dynamic.
Which of them are publicly traded?
S&P is a division of McGraw-Hill, ticker MHP, and it's publicly traded. Fimelac, I believe, is also publicly traded. AM Best is a family-owned company, and Dominion Securities, I think, is private as well. Go ahead.
So you reduced your cash balance significantly. How do you think about capital allocation between share buybacks, acquisitions, and on the latter, what are the criteria you think about in analyzing acquisitions?
Well, the first criteria that I use is I think about what Mr. Buffett says about not doing anything dumb, and that comes first. Very difficult with the type of multiple that we have to do acquisitions that are not dilutive. And we look for acquisitions that are close to our core competencies. In other words, I always say we don't want to go out and buy Krispy Kreme. You know, Moodys is a ratings agency. We have folks who are analytic. We know the capital markets. We know the fixed income markets. We shouldn't stray probably too far from there. So look close to your core. The acquisitions, of course, have to be financially attractive. Most acquisitions brought to you by investment bankers are, by their very nature, overpriced with sort of overblown growth views. So you have to be really careful about what you do. In terms of what we're doing, we find returning value to shareholders is a core part of what we're doing with our capital strategy. And we found that share repurchases are generally, given that we're a growth company, a better way to go than dividends. We have a rather modest dividend, and that's worked pretty well for us.
Sir? This is sort of a generalization of Ian's question, but I remember that slide you put up there where you said the former CFO actually liked long-scale graphs. I'm just wondering, how much room is there for you to put your personal stamp on the role you're in at the organization?
I think there's actually quite a bit of opportunity because we had what was effectively a small company, and it's grown very, very rapidly. So the ability to do a better job with IT, for example, to make sure that all the people are sort of the employees who are a bit finicky. Financial services employees can tend to be a bit finicky, that they're all housed and officed properly. We can do that. We can work with the capital structure. We can do acquisitions. Any number of things now, given the size and the scope of the company, that we're able to do that are really pretty interesting opportunities. So I feel that there's plenty of room to do interesting things. And if you have any acquisition ideas, let me know, particularly accretive ones. Go ahead.
Any dislocation in the market in your share price, or just effectively timing miss, a small timing miss? Have you ever thought about whether it really makes sense for you to be a publicly traded company?
Yes, I've thought about that quite a bit. The problem is the role, or the challenge we have is the role we have in the capital markets. Would the SEC, for example, allow us to be acquired by an LBO firm? The cash flow characteristics of the business are such that that might be interesting. The multiple right now is probably prohibitively high to make us an interesting acquisition for an LBO player. But the public company nature, I think, ensures that we are running our business at a standard that allows us to rate other companies with a clear conscience. So I think our dealing well with the public company rules and restrictions these days sets a good example for others. And I think, though I don't know, it would be a bit of a tough call for the regulators to allow Moodys, with its size, to be a private company again. Not really sure. We haven't actively explored it.
From where does Moodys derive its income? Do you charge for the data on the ratings?
There's a beautiful thing called the issuer pays model. So we are considered a publishing firm, and we're compared to media companies, which is interesting and amazing, and perhaps a different way to look at the market. But we are publishers. So we're protected by the First Amendment, and what we're doing is publishing opinion. So if you issue bonds, if all you guys up there in the sky deck are issuing bonds, you want to differentiate, and someday I hope you do issue bonds. You want to differentiate your bonds from each other. So it's important for you to come to us to get your bond rated so the capital markets know how to think about and price your bond. So the issuers pay us, on average, 4 basis points to apply a rating to their security. And that's how we make money. Now, in the structured finance side, there are sliding scales and different ways of thinking about fees. It's a much more structured fee view on the corporate side than on the structured side. But basically, it's a lot of deals that we rate for 4 basis points. That's basically how we make money.
Just to hear your perspective on Sarbanes-Oxley, to what extent the benefits in your view outweigh the cost of SOX,
supposedly the greatest bane to CFO human existence. I don't actually see it that way. It has allowed for the CFO to do things that really perhaps might have been done otherwise, but it allows you sort of a real mantle to allow you to look at everything within the company. So my very ferocious controller has a SOX team, and we look at several hundred controls within the company. And we look at our international controls, and we look at various things that we're doing to sign-offs on things and so on. So I think it actually does protect us quite a bit from things going wrong. It allows us to escalate problems. It's extremely expensive to administer. We spend about $4 million a year on SOX. It's coming off a little bit in the second year. The first year of implementation was very, very difficult. And it puts a lot of strain on the organization. But if you're sitting where we are and what you do is rate other companies, you better get it right. So I actually feel relatively comfortable that SOX is in place. And I think some of the complaints about it, frankly, have been just a little bit overblown. But for smaller companies, it is certainly much more burdensome. For public companies, it for the most part, I think it has been a relatively good addition.
Can you talk a little bit about the specifics of what made that day where you lost $4.5 billion in market cap such a bad day? Some of the things that happened on a day like that, and what you did to respond to them.
I'm actually trying to forget about it, but thank you for causing me to. I guess I should deal with it and work through it. I never took the T group class here either at Stanford. I was an Army officer, and Army officers don't do that kind of stuff. Okay, what happened that day? The day before was the board day, and the board said to me, "What do you think is going to happen to the stock?" And I talked to them about it, and I had sort of guessed wrong. And our Goldman advisors actually had a bit of a better view. So we're watching the stock, in pre-trading. We're looking at it, and the head of investor relations sits next to me, and he got a call. And he said to me, it seems as though there's an order imbalance. The stock is not going to open today on time. We're going to be delayed. So there comes a moment where you have to go upstairs and see your boss and tell him that. And that's a tough time. That's a very difficult time. And so we explained what that meant, and we had talked to the specialist, and we knew what was going to happen, and we talked about what was going to happen next. And it's difficult. It's very difficult. Then the way we do it, we get on our earnings call at 11:30, and it's sort of like watching your own EKG. You can watch your stock price move as you're talking about what you're doing. So we were quite pleased that actually we hit bottom, and then as we talked, it sort of moved back up. So I thought, wow, I haven't destroyed any more shareholder value. That's good. But it is very challenging, and fundamentally, our business is what the business was, and you have momentum. Money moves quickly. Hedge fund money moves quickly. We don't have a lot of hedge fund investors in our stock, but on 2 different days, the market can have a completely different response to the financial outlook for any given company. It's tough to manage through. So the earnings call was actually quite. If you listen to the playback of it, it was not particularly dramatic, and we continue on, but it is a hard thing to manage through. You have to be very careful that your emotions don't sort of overcome your ability to think logically on a day like that. It is hard. And in that case, having been an Army officer was really tremendous experience. Anybody else?
Can you talk about how the ratings industry is different in other countries and what that means for your acquisitions?
Ratings industry in other countries is perhaps not the pristine, example-setting kind of thing that it might be, here in the U.S. There are some more political pressures, perhaps, in other countries, particularly developing markets. So we have to be very careful when we buy into China, for example, that we have a transfer of technology and our values and our methodologies, so that you have a like rating process across the world, and it's very difficult to govern that, but we work very hard at it. And we have a chief credit officer, Chris Mahoney, the guy you saw dishing ice cream, whose job it is to make sure that all that works, but it's a very difficult job to ensure standards across the world. Our biggest problem right now in China is, while China has a very active commercial paper market, it doesn't have a bond market yet. The reason why China does not have a bond market, near as we can tell, is they can't decide who's going to regulate it. There are about 5 different groups that would like to regulate the bond market in China. So once that's settled, we think that it'll be clear as to what's going to happen in China.
The market seems as though there's a duopoly between you and S&P. How do you differentiate yourself, say, in the next 2 years in terms of, for companies, if they want to choose which rating agency, if they only need one, for example?
Right. Well, I'd really have issue with your duopoly view, because Fitch has 15% market share, and with the billions of dollars that Hearst has put in. I think they're quite a viable competitor. Also in the insurance business, AM Best is really the leading practitioner in the insurance space, so they're very active competitors there as well. How do we differentiate ourselves? You've got to get it right. What we do requires that we predict the probability of default in fixed income securities. So we do a lot of tracking as to how accurate our ratings are, and our ratings are, for the most part, extraordinarily accurate. And you have certain cases where you have problems, Enron, for example, but if you have a fraudulent situation, you're not always going to be able to call that right, but material information has been withheld from you, and that's why there was a criminal trial in that case.
You have benefited a lot from the development of capital markets, structured finance products, derivatives. Do you think that has all played out already, or where do you see growth opportunities going forward, both in terms of products and maybe also geography?
Well, it seems like the intermediaries, the investment banks, whom we appreciate dearly because they do free R&D for us, they have an unending ability to think up new products, and we really do appreciate that, and that's a very, very good thing. So the asset classes, as you saw, keep changing, cell phone towers, 50-year mortgage products. The CDO market, you now have CDOs of CDOs. In fact, now we're starting to see 3 rounds of that. So the level of complexity grows dramatically. And I personally don't have the math skills to rate those instruments, so I stay a long way from them. But there is plenty of opportunity, and structured finance is growing dramatically throughout the world. Also in Europe, the banks have held on to a very important piece of the capital markets, which has not tracked the same way that in the U.S. market, people would go directly to the capital markets and not be funded by banks. We believe over time disintermediation will continue in Europe and also in Asia, which is at an earlier point in the cycle. So that provides real opportunity for us as well. Yes?
I was wondering how Moody's revises its corporate bond ratings. You rate many companies. Do you constantly watch them, and what sorts of things do you look for?
We have a very rigorous ratings process, which we talk about with the SEC and Congress all the time. We have ratings committees which are totally independent from management. For example, I can have nothing to do with the ratings process. There are a whole lot of code of conduct things that go along with that. If you're rating a security, you can't hold any of the securities in your personal portfolio if you're an analyst. So we keep very good separation and make sure that the people who are doing the ratings are not tainted in any way. Beyond that, the ratings teams monitor all the activities going on with those companies. They possess a lot of very, information which is not known to the general market. So it's a big responsibility. But they monitor the companies. They look at all the market conditions and so on. And from time to time, they'll make a different decision on companies. But it's completely up to them, and they are influenced by no one. So the ratings analysts have a tremendous amount of power. Yes?
I know you said that the popularity from today wasn't believable at all, but perhaps talk about that moment when you made the offer and how it came about and the opportunity, how it opened up to you to be CFO.
Sure. When I was CFO of U.S. Trust, it was a great divisional job, but I thought I've made it this far. I'd like to step up to the major leagues and be CFO of a public company. The recruiting firms tend to find you, and being a woman, frankly, or being a more diverse candidate really provides you with a lot of advantages these days because you have much higher visibility because there aren't too many of us. So it really is a very interesting situation. So the opportunity came along, was brought to me by a headhunter to become CFO of Moodys, and I just went down and started the interviewing process. Met all the former CFOs on the board, and I guess I got through that because of my remarkable education. Yes?
In the various organizations where you work, how much variability have you seen between the CFO role between someone who's more focused on internal controls and accounting versus strategy and capital allocation? And how do you think about the CFO role as a stepping stone to the CEO role?
Generally, the people who should be thinking about controls, day to day, your controller should be thinking about controls. I think about controls a lot, but that responsibility day to day is managed by him. I own it. I can't delegate it, nor can my CEO or head of the audit committee or the board. but day to day in terms of watching and making sure that all the controls are being followed, the controller really handles that. And our head of internal audit, who's also a very ferocious sort of individual, another person you want to have at your side. I think that thinking about strategy and capital allocation are really the heart and soul of the job. And I'm lucky to be in a position where I'm able to do a lot of that, which is really very helpful. The stepping stone to the CEO job, more CFOs are now stepping up to the CEO job. I think it's tremendous training. You have a very strong partnership with the CEO. But you really have to think a lot about whether you want to be the full outside face to the corporation, whether you want to spend all the time required to really be the public face of the company. And there's a tremendous amount of pressure in being in that top job. So it's really something each person has to judge as to whether it's something that's interesting to each individual. Some people would have, the ambition and the burning desire to do that, and others are kind of happy, in the CFO role. Quite honestly, I haven't thought a lot about that myself.
You also, in your personal life, also with an investment banker. So how do you separate in terms of the personal and professional? Because, I'm just wondering in terms of Chinese wall or anything like that. I mean, how do you differentiate?
Well, I did recognize this fellow here whose name I don't know, who used to work, Max. Hi, Max. Max used to work for my husband, so he can tell you how much my husband travels. So the first trick is being able to see him at all. So we obviously have to be very careful about those sorts of things. There are some interesting overlaps. I think overall, though, having a spouse who knows what you do, who has the same kind of education that you do, well, he has a JD MBA from Wharton, so not exactly the same kind of education, but a spouse who can appreciate what you do and sort of have some empathy for what you're going through is really very, very helpful. And once in a while, I actually get some free advice that I don't have to pay for, so it's a really good thing. So it all works pretty well. Go ahead.
Sure. Do you feel like Starbucks has actually improved the quality of the ratings that Moodys able to?
They're two separate things, really. We look at whether people are following their SOX controls. Does it cause people to focus more appropriately on controls and, to some extent, governance? Yes, I think it does. I think it does. I couldn't give you a better measurement of that, but yes, I think it's helpful. Go ahead.
What do you think is the appropriate capital structure for Moodys and why?
I let the head of the credit committee really decide that, but we do have a view as if we rated ourselves, where it should be. And my boss, Ray McDaniel, has a very strong view that we should not look like we need the money at any point in time. Our independence has got to be absolutely assured, so we're very careful about that. We have people come in and tell us, and this is stunning to me, we have people who come in and tell us, maybe you should really leverage up the company and make yourselves into a junk credit. And it makes your head kind of explode. It's sort of like, have you guys not looked at what we do for a living? So people give you, the darndest advice, and you write down in your little form, do not want to speak to these bankers ever again. But we do have a sense of what that should be. We have $300 million of debt. We have $160 million of bank lines. We have the ability to draw another $700 million if I needed it under the private placement that I have right now. Given what we do, raising money is not a problem. Having banks not call you to offer you money is actually a bigger problem. Go ahead.
Can you tell us a little bit about how your experience at Stanford MBA has helped in your career?
Sure. With this august team sitting here, it has been tremendously helpful. And I thought the questions you might ask, if I had paid closer attention while I was in the MBA program, what would I have paid more attention to? Since you didn't ask that question, but I'll answer it anyway, would probably be accounting. Accounting is not fun or not always sexy, but you do need to really know it in my job. It's very, very important. The most important thing that I learned, and I think Stanford was very much ahead of its time, was teamwork, and teamwork with all different types of people. And that's a very, very important skill. You really can't get anything done in a corporation these days without the ability to handle teamwork and be part of free-floating work groups to deal with things like, what should Moodys do? What kind of acquisition should we do? What should we do within the regulated business, the non-regulated business? And you work with all different types of people. And if you can't be effective in a team setting, you really can't get anything done. So I think that was probably the main thing that I learned. Also, the connections that I made, the people in my class, which are very strong bonds, have helped me quite a bit throughout my career, and it's been tremendously important and very helpful. classes, other MBA programs that have twice as many students don't have that sort of connection going forward. And it'll be very helpful to you after you graduate from here. You may not realize it now, but it will be. Yes?
Think about the frequency in which you need to update your ratings on companies, particularly in sort of very public situations like GM.
That's probably one of the biggest challenges that we face right now. We're very cognizant of the responsibility we have in a situation like that. You're trying to balance two things, which is predicting the probability of default, and then also making sure that you don't bounce the ratings around too much. So you have to have a view of continuity, but also correctness on the probability of default. So those two things have to be balanced, and that's the job of the chief credit officer to make sure that happens. And so far, I think, so good. But it's a very delicate balancing act, and one that we think about all day, every day. Yes?
The slide you showed on margins and cash flow that the business generates was pretty impressive, especially for an industry that's fairly mature. Obviously the three main players have an amazing franchise. Do you see that continuing? Do you see any threats that would depress margins in the future?
Well, the issue usually is what would we see we're often asked, that could break the business model. The regulatory front is relatively calm right now. It tends to spike up at various times, but the SEC seems relatively happy with what we do and how we do it. We do see a period of increased regulation of what we do, and probably the need for self-regulation. We think that probably there will be sort of a Sarbanes-Oxley type of regulation of rating agencies, which we'll be asked to perform under going forward. So we're looking very carefully about increasing our compliance efforts and things like that, making sure we have codes of conduct so that within the U.S. we're complying with everything that could come our way. In Europe, there are a number of groups which have an infinite number of letters in their names, which oversee what we do. There's a group called CSER, there's a group called IOSCO, which is the International Securities Commissions, basically. So we have to deal with those agencies and make sure that we're in compliance with what they want us to do in their countries. But generally, it goes relatively well. We spend a tremendous amount of time on dealing with that. In terms of what could hurt our near-term outlook, exogenous shocks which are not planned for, which cannot be predicted. If oil goes to 150, that's something which is obviously would be very concerning. But predictable interest rate increases, while it makes our lives a little bit more difficult, we can see that coming, so therefore we can plan for it.
Last question.
I don't know if you can answer this, but how sort of sensitive in general is the business to the credit cycle, and how do you sort of diversify, if it is, how do you diversify that risk away?
Somewhat sensitive to the credit cycle, but probably less so than people realize. We're internationally diversified. Right now, we have big businesses in Japan and Europe. They run counter-cyclically to each other. China's growing at 9%, Europe's growing at 2%, U.S. is growing at 3%. These are rough integers. But people are at different places in the credit cycle, and as well as the funding cycle in different countries, so that offsets. And then we have a couple of businesses. Our research business is a subscription business, $200 million of revenue a year, which is not really related to any of the above, so that helps us. And we have the KMV business, which is an analytical business, which also is not particularly related to anything that we do in terms of the credit cycle. But we're at a more difficult point here in the credit cycle. Very difficult to predict what the Fed is going to do. Somewhat hard to tell if Ben Bernanke or Maria Bartiromo is running the Fed. That's a little challenging for us. So we try to roll with the punches on all those things, and we have quite a few economists in-house, quite a few. So I guess that's basically it. Thank you very much for very good questions.